The biggest trick lenders use: weekly and biweekly payments. Is that really a trick? Scott Terrio is here to discuss it, starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Scott, welcome back.
Thank you.
So this is YouTube and, the podcasting world, and you have to create titles that are clickbaity. That's how you get people sucked in to watch your thing. So today's clickbait title is "The Biggest Trick Lenders Use: Weekly and Biweekly Payments." Now, I personally don't think weekly and biweekly payments are a trick at all. In fact, I wrote a book about it. It's here behind me, Straight Talk on Your Money. And if you go to page 160, which I know you've read many times, I give the example of, I make the suggestion that what you should be doing is paying your bills as often as you get paid. So if you get paid biweekly, you should be paying your bills biweekly. Everything is great. So I don't think weekly and biweekly payments are a trick. In fact, I think it's the exact opposite. I think that's exactly how you should be setting up your payments. But on Twitter, where you frequently get yourself into trouble, you had a tweet, and I'll put it up on the screen here. When going through monthly expenses, new clients new clients coming to see you, almost invariably quote me their payment, but not their actual monthly total. So example, I'll ask them about their car payment. They'll say 346 or 118 weekly, but what they never say is, well, it's $700 a month or whatever. And it's a different perspective when you look at that. So first question, simple question: how often when you're meeting with someone do they quote, when you ask them what their payment is, do they quote it as weekly or biweekly? And then we'll get into why that is or is not a problem.
Sure. And I agree with you on the payments thing, actually, but I think this is an issue of affordability. So we'll get into that too. So clients rarely tell me their monthly payment when I ask them. We're going through expenses, right? And okay, what's your rent? What's your this? What's your that? How much your car payment? And they typically state their biweekly or their weekly payment. So they'll say, whatever, 184 or something. And then I say, so a little bit of quick battlefield math. So 640 a month then? To which they pause and react with some surprise and say, yeah, I guess so. Well, it is. It's 640 a month. It may be whatever, weekly or biweekly, but they are used to that number, and that is how they got here. And so they've been paying these loans for years, some of them, and can't remember their total monthly outlay because they remember that the thing that hooks them, the clickbait you talked about, was the $84 a week, because that's a low number. So to me, this means the finance company, along with the dealer salesperson, have done their job very effectively by putting the monthly figure out of the customer's mind entirely, because typically consumers think monthly, right? Everything what's your rent? What's your mortgage payment? What's your insurance payment? What's your phone bill, your cell bill, your internet, whatever, right? So this is how they get around that mindset.
Yeah. And you're hitting on the area of affordability. So when I think about this, I'm coming from it at the exact opposite way. I'm saying, okay, my phone bill, my cell phone bill, my internet bill, whatever, is $100 a month. I get paid bi-weekly. So my suggestion is set it up on auto payment to send $50 every payday. That makes it more affordable, because when you hit a 3-pay month, you're actually paying an extra $50 in my example. So a year from now, you'll be a month ahead. What you're saying is the exact opposite perception, which is, my biweekly payment is $150. Therefore, I only think of 150. I don't think of 300, but of course, It's actually more than 300 a month, because twice a year in a biweekly system, there's three payments. So you're making 2 extra payments a year. So you're actually making higher payments than what you sort of in your head think. That's what you're talking about with respect to affordability. Then.
Yeah. And you're coming at this from a cash flow standpoint. I mean, you are an accountant, and so that makes sense. And most consumers don't think in terms of cash flow. And that is how we end up being very tight at the end of every month. Most of us, I think, how many Canadians are living paycheck to paycheck kind of thing, right? And lots of them are. So
yeah, the vast majority of them. So that's kind of where we got our clickbaity title from here. Yeah. The trick is,
well, you got to get them in, right?
Well, yeah, we got to play the game.
Otherwise, nobody's watching this.
Right.
So.
We want the algorithm to pick us up. So The trick is the lender emphasizes the small number, the weekly or biweekly number,
Yep.
and you as the borrower should be thinking more in terms of either the full month or the total amount you're going to end up paying on the loan.
Yeah, I'll give you an example. So if I dangle a payment of 168 biweekly or 84 weekly, that number is smaller than quoting you 336 monthly, which if you do the math, that's what it comes to. And this is where the concept of confirmation bias kicks in. I love my behavioral economics, so I think I might have missed my calling. But so confirmation bias is our tendency to search for or interpret or favor certain information in a way that confirms or supports our prior beliefs or wants. Because people want the car, they want the truck, they want that truck, that car. And so therefore your subconscious will bring things into play that will confirm that you ought to get it. And so the weekly payment also just so happens to appeal to tradesmen and construction workers, by the way. So a large portion of trucks are sold to people who work those kinds of jobs. Those people get paid weekly, typically. And so you can say, well, you get paid every week and it's only $84 out of your pay every week. And that's great. So a lot of this is sales targeting as well. And I gotta tell you this. So I used to work for John Deere. I worked for John Deere for 14 years before doing this stuff, and called on dealerships for a living. And tractor or farm equipment dealerships are not much different than car dealerships. They sell equipment, they service equipment, they sell parts. And a dealer told me once long ago that emotional buyers, I'm going to quote him, go into a sale pre-armed to harm themselves. All the salesman needs to do is oblige them. And I love that quote because it's true. We're primed, right? Another behavioral economics term. We are primed when we go in. And so this is a system, right? This is a systematic process where they've got you in there and they know how to get the deal done. So.
Yeah. And you've got to be aware of that. And that's why my preference, if I am buying a car or a tractor, is to look at the total amount I'm going to have to pay.
Yeah.
So if the total amount is, well, take your biweekly payment, multiply it by however many payments there are. If I'm going to be paying $60,000, that's the number I should be focusing on in my mind rather than, $120 biweekly. And when you think, wow, $60,000, that's a lot of money, then it kind of helps focus your mind. So you raise the issue of car dealers. Mm-hmm. So let's talk about them because those are, and I guess car financers would be a better way to put it. Is there a difference between car dealers and car financers? Let's start with that question.
Yeah, I really like this part. So car dealerships, like agricultural equipment dealerships, make their money on the service department, the parts department, used equipment, and traditionally they never made much money on new sales. I know people think that because, that car's $30,000. Well, the place making the money on that's the manufacturer. Dealers get very, very low margins on that stuff. So the other place car dealers make money is in finance. And so car dealerships, what they're very good at is getting you into financing. And this is also where the salespeople are paid. So their commissions there's motivation there because of the financing deal. So when you get a car loan financed at a dealership, they're not actually the ones lending you the money. Dealerships work with several banks, lenders, whatever, and they simply arrange the financing for you. So it's just like any service where there's a middleman, you can expect to pay some of that. And so there's what's called a finance reserve at a dealership. And this is where a percentage is added on to your interest rate. It's usually between 1 and 3 or something like that they get. Okay. So for example, a dealer may be able to get you into a loan at, 5% from one of their lending partners. So that's the buy rate. And then the bank is willing to loan you the money, but the dealer will keep that figure hidden, of course, because they know what's going on in the background. The sell rate is 7%. So that's what they get the difference. And so some of this can come out to, on a $25,000 loan over 60 months, the dealer makes like $3,300. That's a huge amount of money when you sell that many cars. So this is what's going on behind the scenes. And that's why I said car dealerships are are finance companies, because there's nothing wrong with that. That's where they get their margin from complete goods as opposed to service and parts.
Yeah, and you're right. And there is nothing wrong with that. That's perfectly fine, but you want to be aware of that's what's going on. So
yeah, that's the issue, right? Is the awareness, right? And so if you know this is happening and you go into that dealership armed with this knowledge that we're talking about here, you can get yourself out of what could be a multi-year problem that you and I see a lot in our business, is where someone had known that. For example, you can shop around, the dealer only uses certain lenders, but there's lots of car lenders out there. And so we'll talk about, kind of how to defend against this, I guess, in a bit.
Yeah. And so again, and we've talked about this many times before, if I was going to do a course in financial literacy,
mm-hmm.
and I do podcasts on this every year in November during Financial Literacy Month, the number one lesson is figure out what the other guy's doing.
Yep.
What's the other guy's perspective on this?
I think your book mentioned that.
I believe it does. So we've plugged the book twice already.
Yeah. So this is nothing more than being, as you said, aware, financially literate when it comes to cars. I mean, a car is the second biggest thing you'll ever buy.
Yeah,
right? And you might buy a house, but there's nothing else you're going to buy just big as a car, except maybe a boat. But that's much less common.
Yeah, and which is why you have to be cognizant. I mean, we had people come in to say to us, "Yeah, so why'd you do this car deal?" Well, when I went into the dealership, it was actually cheaper if I financed it than if I paid cash. They were willing to give me an extra couple of bucks on my trade-in if I financed it. Well, yeah, because of what you just said, the dealership may end up making $3 or $4 or $5 or $6 grand on the financing in addition to the money that they're making on the car. And in fact, dealerships, and I'm talking about prior to 2022, which is the year we're in now, where there's shortages of cars. And so you got to pay sticker price if you want to buy a vehicle.
Yeah, I was going to mention that too, Doug, is all this goes out the window with the COVID thing, with the chip shortage, right? I mean, we're talking about normal times here. We're not talking about, people can sell their trucks they've had for 5 years for basically what they bought them for, because it's got a chip in it. So all of this is in the frame of normal times, right?
Yeah. In normal times, you would, negotiate with the dealership and they'd say, well, we'll give you a better deal if you finance it.
Yeah.
It seems kind of crazy. Doesn't the dealership want the money? Well, no, the dealership's getting the money from the finance company. That's not a big deal, but they're going to get a little bit extra.
Well, and they'll get volume discount from the manufacturer at the end of the year, right? So there's lots of things going on, right? It's, a dealership gets a big volume check from Ford or GM or whatever at the end of every year. So they get volume, they get the financing money, they get a small margin for the car, and then of course they get you in for parts and service.
Yeah, and so a dealership can almost in normal times give the car away at cost.
Yeah.
But they're going to make money, as you say, parts and service, and then on the financing. So they're not really in the business of selling cars. They're in the business of selling financing. They're in
the business of arranging financing when it comes to selling cars, largely leasing, same thing.
Yeah. And there's nothing wrong with that. That's just the way it is, but you want to understand it. It's just like going to Costco. They're not really in the business of selling stuff. They're in the business of collecting membership fees. That's where they make a big chunk of their profit from. So
and people buying more stuff than they need.
Buying it in huge quantities. So understanding what's happening on the other side is important. So, okay, now usually we do the practical advice at the end, but let's just go right to practical advice right now.
I'd like to do it now because I think it's on topic. So, let's just do it. And then I want to give a client story as well, because I want to make this, sound kind of actual tangible. So your best defense for this, and this seems so easy, but is to shop for your own car financing. Okay, so first thing you do is you say, here's what I can afford a month. You sit down, you say, okay, I can afford $300 a month, or I can afford $500 a month, or I can afford whatever as your ceiling. Okay. And then you go and you shop for your own car financing before you go to the dealership. You get some online quotes, you call a few banks, credit unions, whatever you got to do. Once you get those quotes, you take that to the dealership and you see if they can beat it. If they can't, well, okay, I guess I'm out of here. Voting with your feet in a dealership usually gets things to change. If customers, once they're in a dealership, rarely get up and leave, and this is what the dealerships rely on, because it's sales, right? And so if you say to them, here's what I've got online through this other place, and then you can get the deal that you want. And if not, you go elsewhere. So you don't have to accept what they do. I mean, think of the dealership as one lender. I mean, there's millions of lenders. So why would you restrict yourself to just do that? You can also ask to see the lender approval from the dealership, but most of them won't show you that. So, but I think if you set your monthly and you go and you shop around before you do anything, and you go into the dealership, you say, I want that car or that truck. And you say, here's the deal I've got online. Here's the quotes that I got. Can you beat this? And I think you're putting yourself in a much better, much more advantageous position.
Yeah, I totally agree. And so what you're advocating is a 2-point strategy. Number one, figure out what you can actually afford.
Yep. Do that first. So do this backwards, right? Because most people do it the other way around, Doug, right? They want that truck or that car, and then they end up with a payment.
Yep.
Well, the payment they end up with monthly was $200 more than they can actually afford. And I'll put my client story in now, because I think that's timely from that last point. You and I had a guy in I don't know, a year ago, 2 years ago, whatever and he'd been paying for a truck loan for 4 years. He had rolled a car loan into it previously. And this is an older guy. He's maybe 60, and he's going to retire soon.
I'm 57, so I wouldn't say 60 as well. But anyway,
much older guy, 67.
There you go.
He was 86.
That's
so
good.
he had rolled a car loan in, which we all know, or most of us know, is usually a bad deal. He was paying $916 a month for this truck, and all he did was drive to work and back. He worked at a government institution as an admin person. So $916 a month was his car payment, was truck payment. $350 for gas, because it's a truck. $215 for insurance, because he had a couple accidents years ago. So he was paying $1481 a month for his truck, which was only $200 less than his rent. So extreme example, but he told us that he felt like he'd been dragging that truck around for years, which he was financially, and that it had determined a lot of what he did every month in terms of financial decisions. So if you can avoid this situation, you're going to save yourself a ton of trouble, because this can affect you for many years.
Yeah. And you and I have had this discussion with people many, many times over the years. And I find it's a harder discussion with males.
Yes.
And I guess I'm being sexist by saying that, but men seem to be more attached to their vehicles. Mm-hmm. And particularly if it's a truck. Yep. For some reason. And you're right. I've got this loan. I'm paying $900 a month, and I could be taking a taxi to work every day, an Uber, mm-hmm. and it would be cheaper than the vehicle.
Yeah.
But I wasn't thinking about that when I got into it. So I think the practical advice is, number one, what can you actually afford? And it's not just payment. It's how much is insurance going to be?
Total cost. Yeah.
Yeah. Total cost. So if you're
gas, insurance, maintenance.
Right. If you're going to be buying a 2022 whatever, get on the phone with your insurance company and say, okay, what's the insurance going to be on this vehicle? Yep. And then go online, figuring out how much gas is going to cost. I mean,
do it all ahead of time.
Do it all ahead of time.
What you don't want to do is be figuring it out in the salesman's office as your first crack, because they've got a hot one on the go here, right? This is great. They're rubbing their hands. And so, and again, that's their job. There's nothing wrong with that.
Well, and how can you figure it out in the salesman's office? You're not going to be calling your insurance company and figuring out.
I know. I'm talking about the payments more, but right. Yes, you're not sitting in his office exactly thinking about insurance and gas and maintenance and all that stuff. So you've got all the time in the world on your own before you go to the dealership. So do this stuff ahead of time. Build some discipline into it. Say, this is what I can afford per month, and then that way. And the word no is the most powerful word in the English language. And so, say no when they try to upsell you to the next truck or car. You say, nope, this is what I can do. You figure it out for me. Yeah,
this is my budget. And the other thing you've got to do is compare apples to apples.
Yeah.
So if I get this car or this truck, here's how much it's going to cost me all in. if I don't have this particular vehicle, what are my other options? Well, one option is public transit. Now, that doesn't work if you live out in the middle of nowhere where there is none. But if you live in a city, okay, the problem with public transit is it's going to take me longer to get to work because I got to catch this bus and that bus, and it's only every 15 minutes or whatever. Okay, so there is a time value to, there's certainly a value to your time. But okay, how much would it actually cost to take public transit versus taking the vehicle? The other issue is convenience. I chatted with a husband and wife this week who live in Toronto, but they have a set of relatives over here and another set of relatives over there, you know, in two adjoining towns. So they cannot take the subway to, you know, Peterborough to visit their in-laws. So, okay, a vehicle is necessary for that, but you do not have to have this specific vehicle. And in fact, you can rent a vehicle. That's actually a thing. And
we have, I mean, we have a lot of clients in Toronto who do that, right? They're, you know, her parents live in Cambridge, his parents live in, I don't know, you know, Oshawa, and they rent a car to go on their weekly or bi-weekly or whatever visits. You know, that can make sense too. If you're so in other words, if your main area of living is urban, and 90% of your life is urban, you could probably get away with not having one at all and then renting and just to do your excursions, right? But I understand the vehicle thing, that the need for a vehicle, and as you said, places where there's very poor transit, it's unreliable, it's not realistic. But yeah, again, we're back to what vehicle, right? What do I need that vehicle? Because a lot of this, back to your masculine thing, it's emotional. You know, the confirmation bias thing, these cognitive biases we have are also emotional. And so you get excited about, you know, the car that you want. And that's where sales comes in, you know, getting more car than you may have needed.
Yeah. And we all remember when we got our driver's license, that, you know, in my case, it was 41 years ago, but it's like, okay, now I'm independent. And so when I lose the car, I'm not quite as independent. I had a client, and I believe this was in our Brantford office many years ago, who did this math and figured out, you know what, it is cheaper not to have a car. And Brantford does not have a subway system. No. So, but they do have public transit. But so what she did was she made a deal with the local car rental place that once every 2 weeks, she would come in and rent a car at 9 o'clock in the morning and have it back at 5 o'clock at night. So she never had the car overnight. So she had the deal worked out with them. I can't remember what the numbers were, 50 bucks a day or whatever. So she did all of her running around on that day. She booked her doctor's appointments. She went and visited her mother. She did her grocery shopping, anything she needed, boom. That was a fantastic idea, I thought, because it was costing her $100 a month to have all the convenience of a vehicle, as opposed to $1,000 a month or more, which is what this.
No, think about that over a year or 2 years. That's a massive amount of money.
Yeah, it's a massive amount of money. Now, I realize everyone's situation is different. You've got a couple of little kids. Well, I guess they're bigger now. They're not infants. You know, kind of hard to be schlepping hockey equipment and goalie pads and all that kind of stuff, you know, to the arena at 6 o'clock in the morning before the buses are running. So there are cases where, yes, you got to have a vehicle. You just want to be crunching the numbers to make sure it makes sense. So how then does one know if a vehicle loan, or any loan for that point of view, is truly affordable then? Is it as simple as what I said, you crunch the numbers, or is there more to it than that? Yeah,
well, I think between the two of us, we got close to that here, because you said overall cost. So it's 60 grand. Okay. And this is where they, you know, the weekly and the biweekly payments mask that. The monthly total output, I think, is very important. That's where your real affordability comes, because that's how we live. We live month to month. We, you know, most things we pay are monthly. So if you're paying 200 more than you kind of hoped you would be, that's a lot of money over the course of a number of years. And I would quote that it's something like, where did I hit that number here? Okay. So more than half of all new car loans in Canada are currently financed for 84 months. That's 7 years or longer. More than half of them. You know, that's mind blowing to me. We see it all the time. And so, you know, the industry standard used to be years ago, the car would be over 60 months, 5 years, but low interest rates settled in, and, you know, payment periods began to stretch longer and longer to make monthly payments as low as possible, or those weekly and biweekly payments. So affordability is the main thing here. And these long car loans, the longer you pay on a car loan and don't accelerate the payment or pay it faster, it's a depreciating asset. It's a wildly depreciating asset. Again, in normal times, not when there's chip shortage. But we see people who are paying 45, 50 grand on a car that's worth 20. Mm-hmm. And so if you can get that, either the term from the start shortened, and it's more aggressive and more expensive, but the faster you can get a car paid off, the better, because you've got something with a value left afterwards. Because then the next car you buy and the next car you buy, you're in a much better position.
We're getting a little glitch on the internet here with your sound, but paying
cash or trading it in for cash. So it's time is. Oh, sorry.
Yeah. No.
What did you hear last?
What you said. Yeah. Okay. I got the gist of it. The point you're making is that you can go down or you can go up. So if I have a shortfall on my car and then I buy another one, I'm taking that shortfall and rolling it into the new loan. That was the story you told about our client who was paying $916 a month on his truck loan.
Yeah, he's paying for two cars.
He's paying for two cars because the shortfall was rolling.
And only using one,
Right. Whereas if you have a car loan that you pay off in 3 years, then great. By the time I go to roll it into my next car, I've actually got equity in it. They give me $3 or $4 or $10,000, and my loan payments
it's kind of a race against time, right? Like cars depreciate so fast under normal conditions that the faster you can get that paid off, the better, because you end up with an actual asset that has real equity, real value to it, right?
Right. So if you can make accelerated payments, do it.
Oh yeah, for sure. Yeah.
And
I mean, there might be penalties or whatever for doing that, but it won't be anywhere near the value of ending up with an asset that a rolling asset that has value to it, for sure.
Which is another reason, to go back to your first point, to shop around and understand what the rules are. What are the terms of my loan? Am I allowed to prepay it? What's the penalty? Is there a penalty? Is there no penalty? Whatever.
Yeah. So have it set up before you do anything.
Right.
To do everything in the comfort of your home where you're not under any pressure.
Yep.
Shop around online, get the financing sorted. Once you get the financing to where you'd like it, via, comparisons on the internet and getting quotes, you decide the vehicle you want, you figure out your insurance, your total cost, then you go to the dealership. You say, well, can you match this? Can you beat it? And so in other words, don't do everything the usual way, which is I want that truck. And then they determine what your deal is going to be. You do your deal ahead of time, and you go in there and you say, here's what I want.
Yeah. And you're much less likely to get into trouble. So I think that is excellent practical advice. Are there any final comments you would like to make on anything to do with this topic?
Well, I covered everything I wanted to get in there. I think I did want to point out that stat about the more than half of all new car loans in Canada are 84 months or 7 years or longer.
And that is an amazing stat. And so when you're entering into an 8-year car loan, are you really intending to keep the car for 8 years?
And you would have the kind of car you'd have to buy for there to be significant equity at the end of 8 years is a car you don't need, most likely.
It's unlikely.
Like you'd have to get a Porsche or something. Like seriously, stuff that holds its value very, very well over long term and is a real luxury vehicle. For most people, they need a vehicle. And so paying 8 years for that, the thing will be worthless at the end if you're just getting an average vehicle.
Yeah, and it depends, of course, how you drive it. And if you've been in lockdown for 2 years, then I guess you got fewer miles than you thought. But
but I'm talking market value, right? I'm talking like, whatever shape the condition is. Like it could be mint, but if it's 8 years old, well, it's only worth X dollars, right?
Yeah, the technology changes. You got, dings and scratches and whatnot. I mean, I am not a car guy. I drive a 10-year-old car, 12-year-olds, whatever it is.
We should have had Ted in for this.
That's
one.
right.
Done a round table. That would have been a fiery discussion.
Is much more of a car guy than I are. But I think you're right. The closing comment is you got to look at the big picture. So we did use the clickbaity title here of, the biggest trick lenders use, making you do it weekly or bi-weekly. Well, it's only a trick if you don't understand the total amount you're paying.
If you let it be a trick, right? I mean, it's almost a non-trick. I think we all get what's going on. It's just that we get emotional and we let the process drive us as opposed to driving it ourselves.
Right. It's an obvious trick. Well, we've made it obvious to everyone today. If the reason you're going weekly and bi-weekly is to get it paid off faster, fantastic. I'm totally on board with that. So
me too.
Figure out in advance what your budget is before you walk into the dealership. Yeah. Take a look at all the costs, not just the payment, but insurance and everything else. Call your insurance company, figure it out. And then, as you said, shop for your own financing.
Understanding that the dealership is only using one or two lenders. You have access to hundreds.
Everyone. Yeah. So you decide what the deal is best. If the dealer gives you the best deal, fantastic. Take it. If you can get it better somewhere else, then do that as well. And you should be good to go. Excellent. Scott Terrio, thanks very much for being here.
Thanks again, Doug.
There you go. So that was our clickbaity show. Hopefully we explained it. Feel free to leave a comment on YouTube if you agree or disagree. If you are watching this on YouTube, please hit the like button and the subscribe button and the notification. Whatever bell you see, just click that. It helps get the word out and get the algorithm to show this to more people. If you're listening to this in audio form on audio podcast or Apple Podcasts or Spotify or whatever, then again, like and subscribe. We appreciate it. That is our show for today. I'm Doug Hoyes. Until next week, that was Debt Free in 30. Or 31, as it turned out.
I enjoyed that.
Yeah, that was good. So